Thanks. Thanks for the opportunity to speak to you guys. This is at 2 a.m. my time in London, so I apologize if I look a bit tired. I'm a little bit slow. Let me just give you a very quick intro to my background, which kind of would lead to the topic today, the uniqueness of the Chinese A-share market. So I grew up in China, then I moved to the States for education. Then after that, I moved to London to become a professor in finance at the London School of Economics. So I know China pretty well, and I know the U.S. pretty well, and I know Europe pretty well. And my research is in empirical asset pricing, and for the first 10 years of my career, I was focusing primarily on the U.S. market and European markets, so the developed markets. And then in the last 5 to 7 years, I have sort of turned my attention more and more to the Chinese market and to developing markets. Okay, and also in my capacity, as a professor in finance in London, I have had the opportunity or the privilege to work with a large number of top tier asset managers, in Europe and also in New York. Okay, so my it's from my experience, I can tell you definitively that the Chinese market is unique. There are a lot of unique features about the Chinese market that differentiate it from the developed markets, and Luz have touched upon some of those. Right, the trading cost is incredibly high in China at the moment. You need to have the knowledge, the technology, the experience to trade Chinese stocks. The regulatory environment is quite different in China versus the US or Europe. Now here, I'm just going to focus on one aspect of the key difference between the Chinese market and developed markets, which is investor composition. To next slide, please. And for that purpose, I'm going to talk about two academic research papers, one by myself and my co-authors, and the other one by the two founding partners of Mingshi, Professor Yuan and Professor Rob Stamba. So in a recent paper that I wrote together with my co-authors from Tsinghua, what we're doing is we're looking at very granular data from the Shanghai Stock Exchange. So we had access to account level data for every account at the Shanghai Stock Exchange for the period of 2014 to 2015. So we're able to observe every account's trading, holding, performance on a daily basis for 2 years. So there are about 50 million accounts on the Shanghai Stock Exchange. Accounts owned by individuals, accounts owned by institutions, accounts owned by corporations. So I want to say two things, and it actually took us by surprise as well. Well, number one, in terms of investor composition, the Chinese market is big, right? It's about 6 trillion USD in 2015-16. Now today, it's about 8-9 trillion USD. The US market is about 4 to 5 times larger than the Chinese market. But in terms of turnover, the trading volume, the two markets are not that different. Okay, so number one, it is a big market. But in terms of composition, investor composition, it is very different. So the US market is primarily owned by institutions, right? 85% of the US equity market is owned by large institutions and only 15% by households. Now in China, the picture is flipped. So retail investors own about 25%, institutions about 15%. Now you're going to ask, where does the rest of the remaining go? The rest 60% is actually owned by corporations. So it's cross ownership between different firms. You can think of that as essentially indirect ownership by the government, right? So, China, Construction Bank of China is actually a large shareholder in China Petroleum. Okay, that's essentially sort of state ownership across firms. Okay, so we're going to ignore the 60%, focus on institutions versus retail. So 25% retail, 15% institutions. So retail actually own a bigger chunk of the Chinese market than institution. Now, that's not the end. What's really exciting or interesting is the trading volume, the turnover. So, retail investors contribute nearly 90% of the turnover in the Chinese A-share market, whereas large institutions contribute about 10% of the turnover. Corporations barely trade. Okay, so corporations account for about 1.5% of the turnover. So in terms of turnover, it is really a retail market. 90% of the turnover is contributed by households, okay, by small investors. Okay, So that's the first very interesting observation that we made. Now, the point of the paper, it's an academic paper, so we're going to make an economic point. So what we're interested in is the question of wealth redistribution in the Chinese A-share market during, one of the largest bubble crash episode in the history of the Chinese stock market, right? So the Chinese A-share market went through a roller coaster experience in 2014, 2015. So from July 2014 to June 2015, the market went up by more than 250%, more than tripled essentially. And then from July 2015 to the end of 2015, the market crashed by nearly 60%. Okay, so it's really a roller coaster experience. We started off at slightly above 3,000 points in the Shanghai market, and then it went up to over something like 7,000 points, and then come back down to something like 4,000 points. So that was sort of the background. And then, so our question is something really simple. So we're trying to understand during this episode, who gained and who lost. Okay, so what we did is so out of the 40 million retail accounts, we classified those retail accounts into 4 groups. Okay, based on wealth, based on account size. Okay, so we use a cutoff, sort of a pretty modest cutoff of 500,000 RMB or 70,000 USD to classify the sort of the small accounts, right? The kind of poor guys. So they account for about 85% of all accounts on the Shanghai Stock Exchange. And then we used a cutoff of 10 million RMB or about 1.5 million USD to classify, to determine the large accounts, the wealthy guys. Now they account for about 0.5% of all accounts in the Shanghai Stock Exchange. Now, in terms of total wealth, not surprising, the two groups, right, the ultra wealthy group and kind of the poor group had kind of similar total wealth in the stock market, right? Despite the very different numbers of accounts. Okay, so they each had about 1 trillion RMB or slightly more than 1 trillion RMB in the stock market at that point in time, and they contributed sort of a similar amount of trading volume during that 18-month period. Okay, now the headline result of the paper is that during this 18-month period, the top group, okay, the ultra wealthy group, okay, earned more than 250 billion RMB. Whereas the bottom group, okay, sort of the poor guys, lost something around 250 billion RMB in that 18-month period. It's only a year and a half, right? So there's a huge amount of wealth transfer from the poor to the ultra wealthy in the stock market. Now the bottom line is that there's when you think about sort of retail trading in the Chinese market, it's not sort of one representative household or retail investor in the market. There's tons of heterogeneity across those investors, right? You have sort of smaller guys who are constantly losing money in the stock market, and you have those ultra wealthy mega accounts that are making money in those accounts in the stock market, right? So in some sense, you can think of those ultra wealthy mega accounts playing the role of hedge funds, playing the role of large institutions in the Chinese market, before 2014, 2015, right? Because institutional presence was pretty small in 2014, 2015, and it's something I'll talk about in a couple of slides. It is growing, but back in 2015, 2014, institutional presence was pretty small, and the retail guys, the mega accounts, were essentially playing the role of large institutions. Okay, to next slide. Okay. So from the previous slide, what we saw, or from my paper, what we see is that retail dominance, right, in the Chinese A-share market is very different from the U.S. market or the European markets, and trading cost is very different, short selling mechanism is very different, so on and so forth, right? So it's natural to ask the question: do we see any difference in terms of return patterns? Okay. So let me just say, there's tons of differences in terms of return patterns in the Chinese market versus the US market or the European markets. I'll give you one example. So Louis touched upon this. Price momentum. Think about, one of the most celebrated anomalies in the US market and in the European market. Price momentum, right? If you buy the winners of last year and sell the losers from last year, you get about 12% in the next year. It's a time-tested trading strategy in the US and in Europe. It doesn't work in the Chinese market. Okay, there's no momentum. Well, at least up until 2019, there was no momentum. In 2020, there's a bit of momentum. Okay, that sort of tells you, if you are sort of a global hedge fund, Citadel, Renaissance, and if you want to apply your trading strategy, your signals that you developed in the U.S. market and in European markets directly to the Chinese market, it's tough. Okay, things, chances are it's not going to work out. Okay, so here's a paper by Professor Yuan and his co-authors, and what they show in the paper is, so they're looking at two common factors in the U.S. market, right? Fama-French value factor and Fama-French size factor. And by the way, so Jean Fama won the Nobel Prize in economics in 2013 for his contribution to progressive pricing. And a big part of that contribution is the proposition of the Fama-French three-factor model, right? That is a three-factor model, changed the asset management industry in the U.S. So what Professor Yuan and his co-authors found is that, well, size and value also work in China, but then you have to modify the way you construct the size factor, the way you construct the value factor. Okay, so I'm just listing two sort of prominent changes you have to make in the Chinese market. Well, number one, you have to exclude the bottom 30% of all stocks traded on the Shanghai Stock Exchange in order to recover the size effect. And here's why. Again, it's unique to the Chinese market. So in China, if you look at the smallest 30% of the stocks, most of them are not making a profit, right? A lot of them don't even have revenues, but they're trading at a pretty high multiple. And the reason is, well, those firms have a shell value, right? So for a private firm to go public in China, you have to go through layers and layers of regulations. So kind of a backdoor of IPO is by purchasing one of those shell companies. So it turns out there's the shell value would completely destroy the size effect if you don't control for that. Okay, so that is important. And number two, so in the traditional Fama-French model, value is proxied by the book to market ratio. Now in China, book is defined in a kind of peculiar way. So book to market ratio actually doesn't work that well in the Chinese context. Okay, a better proxy for value is actually the earnings to price ratio. So on the right hand side, what I'm showing you, if you look at the bottom panel, what I'm showing you is the earnings to price ratio kind of driven value factor versus the book market ratio driven value factor. The book market ratio value factor is on the bottom in green, and the earnings to price ratio driven value factor is on top, the blue line, right? You can see, it's the value effect is really an earnings to price ratio effect, not a book market ratio effect. And on top, what I'm showing you is the value effect in China versus the value effect in the US. Now it's well known, right? The value effect has largely disappeared from the US market in the last 10 years. In the Chinese market, it's been doing extremely well in the last 10, 20 years. Okay, to next slide, please. Now here's a related phenomenon, something we call the quality effect, right? So the quality premium was first documented by Cliff Asness, Lasse Peterson, and Frazzini from AQR back in 2018. And AQR has since launched a number of products tracking the quality effect. Now, the quality effect is very intuitive, right? So what you want to do is to buy stocks or buy firms that are profitable, that are not very risky, and also are cheap in terms of some multiples. You get about 4.5% a year in the U.S. market, about 5% a year in European markets. It also works in China. Okay, so the quality effect is also there in the Chinese market. Just it's bigger. You get about 8% trading the traditional quality effect proposed by Cliff and his co-authors. Now we can do even better. Okay, it turns out in China there's excuse me. So in China, there's a pretty good way of predicting future quality by looking at past earnings to price ratio. So we can construct an expected quality factor based on the earnings to price ratio and do even better than the traditional quality factor. So the expected quality factor generates over 12% a year. Now, again, it just tells you, the Chinese market and European markets and US markets are very different, right? The factors that you think that should work in the US market or European markets, like the price momentum effect, it doesn't work in the Chinese market. Now, the factors that you think are disappearing in the US market or European markets, like the value effect, the size effect, they work very well in the Chinese market. Now, of course, the key thing here is that models to suit the uniqueness of the Chinese setting. Okay, and the reason for the difference is obvious, right? Because the Chinese market is different. You have the investor composition is very different. The trading frictions are very different. The technology is very different. The trading cost is very different, and so forth, right? So you just got, in order to succeed in the Chinese market, you need to understand the local culture. You need to understand the local institution. You need to have boots on the ground. You need to, have serious research in the Chinese A-share market. It's not something you can easily kind of achieve by deploying the technology, the signals, the factors they construct for the U.S. market. Next slide, please. Okay. So let me spend just 2 minutes or a couple minutes on the future of the Chinese A-share market as I see it. Okay, now I think a lot of exciting things have happened in the last decade, as Louis has pointed out. I'm just going to tell you how I see the market moving forward in the next decade. Okay? A lot of things are going to happen. A lot of exciting things are going to happen. There's going to be a lot of new data, becoming available in the next 5 to 10 years. Already, we're now able to see more detailed data, more details of live data from the exchange in terms of the order book in the last couple of years, and then going forward, I expect more and more live data to be available to investors. Alternative data, with social media, with online discussion forum, we're going to see a lot more alternative data in China, from news media, from social media, from social media, from online discussion, from conference calls with investors. We're going to get tons of trillions of gigabytes of data, alternative data that just sit there waiting to be exploited. Increasing international presence, right? So the Chinese government is very conscious of attracting capital from foreign investors. We're already seeing an expansion of Stock Connect and QFII program, and we expect to see even more of that in the next few years. Short selling, right? So single name short selling is very difficult today. You cannot really do it in the A-share market directly. You have to do it through a Stock Connect or through the QFII program. Okay, but inventory is fairly small. In the next 5 to 10 years, we expect single name shorting to become more readily available. There's tons of opportunities in single name shorting. Okay, and Mingshi is one of the first ones to be engaged in single name shorting. Futures access by foreign investors. Futures access. So foreign investors will be able to directly trade futures contracts through the QFII program this year or next year. Capital market access for investors will be able to access onshore IPOs, through Stock Connect or through QFII program. ESG. Let me spend 30 seconds on this because Louis and I have been working China ESG for the past 2 years. If you look at sort of the U.S. market and the European markets, right, ESG has been a major topic for at least 20 years, right? And in fact, the first ESG index in Europe and in the US was introduced in 1983, nearly 30 years ago. So, so people have been nearly 40 years ago. So investors, regulators, and firms have been thinking about ESG for a long period of time in those developed markets. Now for China, this is a completely new concept, right? So, Louis and I started talking about ESG back in 2019 because there was a bit of discussion of ESG by the government, by regulators back in 2019, and we've been working on an ESG index since 2019. Okay, now we wrote a paper in July 2021 to document some of the facts that we identified with the data. Okay, the bottom line is that China is about 20 years behind in terms of ESG development, right? So if you look at US, especially Europe, in the past 10, 15 years, there has been trillions of dollars or trillions of euros flowing into ESG related products. Okay, now for China, it's completely new, right? So what we show in our paper is that before 2019, there was essentially no awareness of ESG issues in China, and things changed pretty dramatically in 2019. Remember the government, right? So President Xi, pledged, right, carbon neutrality, carbon peak and then carbon neutrality, carbon peak in 2030 and carbon neutrality in 2060. In a video call with the UN in 2020. Okay, so things changed dramatically in the last couple of years, and I think this is really the beginning of the Chinese ESG super cycle. And remember that in the US and Europe, this the ESG cycle has been going on for 20 years, and this is just the beginning of the Chinese super cycle, and we think the ESG theme is going to be super important in the next decade or two. And finally, the presence of large institutions is going to be huge. It's going to be more important, right? The Chinese market is certainly moving in the direction towards the US market, right? Today we're at about 20, in terms of the trading volume, institutions account for about 20% of the total trading volume, and retail about 80%. Okay, and in the US, it's 100% institutional trading volume. Retail investors own about 15% of the equity market, but they contribute a tiny fraction to the total turnover. Okay, so China is definitely going in that direction, and I think during that process, a lot of things will change, and a lot of exciting things will happen. Okay, and we're certainly excited about that. Okay, that's all I want to say. Thank you, Luis.
Thank you, Professor Loh. Here is Stephen Lee's contact information for everyone on the call. I believe we have some Q&A, but maybe I'll stop sharing and we can.
I have a couple of questions for you guys. Probably this one goes to Mr. Prescott. Here is question one is, we were able to observe good performance on a single stock short strategy since 2021. Yep. What structural factors contributed to this performance? And do you think the quant strategy will continue to build on this current momentum? What's your think about that?
Yep. So, short answer, we internally expect single stock shorting to be our largest source of alpha over the next coming years. We think it is one of the most exciting opportunities in the China A-share market. We also consider ourselves a leader in it. And so we think that those outperformances that you have seen this year, we absolutely think they're going to continue. Now, what was the difference between this year and last year in terms of our portfolio, and what did we learn from, we started doing single stock shorting in a large way in September 2019, and 2020 was a very interesting year. We kind of had some ups and some downs. And the biggest thing we learned was about the capacity of the strategy. So we did a lot of back testing of broker inventory files, availabilities, assumptions of allocations and recalls, etc. But when it came down to actually implementing the strategy, surprisingly, the inventory we actually got from brokers was quite a bit less than they showed us when they were, pitching their prime brokerage platforms. And the recalls were a lot more, and the allocations were less as well. And so we, at the beginning of 2020, thought that we could run a $1 billion single stock short portfolio. That was what we calculated as our maximum capacity. What we learned over 2020 is that we can nowhere near do that size. Our maximum capacity is around 300 million right now of single stock shorting, which is incredibly small. Right? And that's why for our Optima fund, we do 30% single stock shorting, 70% index shorting. So the whole fund can only be around $1 billion of risk. And when we did that change in capacity calculation and upgraded our signals based on that, which was in February this year, And basically, last year we had around 100% of our shorts in single stocks and $1 billion of risk. It was just too large. It was too large for the market. And so this year we brought way down the size, adjusted the models, and now it's doing incredibly well. And so, what did we learn from last year to this year? The real capacity that can actually be run and generate that high alpha. And yes, given that we now make, assuming we stick to the capacity limit as it is right now, and volumes and inventory stays around where it is now, yes, we think it's going to be an exceptional alpha driver.
Okay. Professor Loh, do you want to add some comment on that, or you want to go to another question?
Yeah, I think I largely agree with Louis. It's going to be. Oh, sorry, I mute myself. Apologize for that. Yeah, no, I think I totally agree with Louis. It's going to be a very exciting field of research going forward. Most of the quant investors or quant shops in China are used to the long side alpha, and exploiting short side alpha is a new concept to most investors in China. And Mingshi is, we're one of the first to start trading, to start exploiting alpha also on the short side. And I can expect the short inventory availability to increase dramatically in the next 5 to 10 years. So there's a lot of opportunity there.
Okay, and there is a question number 2. The question is, a number of government-funded industries such as electric vehicle value chain, semiconductors, and solar power are listed in A-share, and many well-known Chinese big tech companies are listed in H-share. In the 14th five-year plan, the Chinese government announced that it would foster manufacturing with a focus on carbon neutral and technology independence. And there is an opinion that this can have a more positive effect on Asia market. So, yeah, any thoughts on this opinion?
Yes, I'll start.
Mm-hmm.
I mean, without getting into the details of the subsectors there, I'll make 2 points, and Professor Loh can expand. There's certainly an ESG. We're at the beginning of an ESG, what we call super cycle, with respect to the government initiatives and the allocation that's going to be going to green companies across the sectors, and specifically focused on the Asia market. In fact, we're trying to launch a green quality index this year if you're interested. But with reference to green or any other feature, talking about A-share versus H-shares, this is really a regulatory commentary. And you look at the recent crackdowns on education, et cetera, all those stocks were listed in the US. Okay, when we talk about the crackdowns on Alibaba to a degree, right? These are all overseas listings. This, for better or worse, there is much more scrutiny of Chinese listed companies overseas compared to onshore, because there is a real objective of the central government right now so that for Shanghai and Shenzhen to not play second fiddle to Hong Kong and the US market. And that's not a bad thing. That's not a bad thing. That's why that they're very resistant to having A-share futures listed in the Hong Kong market. The goal of CSRC and the central government as of right now, and from my observations and from the research that you read, is very much trying to boost the onshore market rather than just have the mega caps listing offshore. And so that, although there will be some friction for the stocks that are currently offshore, it is going to be positive, whether it's in the ESG space, whether it's in a variety of other areas for the domestic market.
Yeah. Let me just add a couple of things to what Louis just said. So I think there are 3 main challenges facing China today, right? Well, number 1 is the geopolitical contest between US and China that Louis touched upon. What we're going to see, I think, in the next few years is the delisting of many of the Chinese firms currently listed in the US, and they're going to come back. Well, there are 2 outlets, right? Going back to A-share, going back to the domestic market, and I think a lot of those firms are going to come back to the A-share market, and that will kind of boost the capital base of the A-share market by some pretty substantial margin which is great for the A share for the domestic market. And number two, perhaps the most important challenge facing China today is the demographic shift, right? The population is aging, and the birth rate is fairly low, right? So a lot of the government policy is really targeted at this aging, the population aging issue, right? The crackdown on the education sector, crackdown on the video game sector. It's all targeted at essentially they want to solve the birth rate problem. Now the couple of things. Well, number one, I think it's there is a bit of sort of unexpected component to these policies. Okay, so maintain kind of a balanced sector exposure, I think, is important, and that's advantage to a quant shop like Mingshi, right? We always try to have a balanced approach to a sector investment, unlike fundamental investment shops. And number two, I think we should also try to understand kind of the mentality of the Chinese regulators, of the Chinese governments. Right? I mean, they're not doing things randomly, right? What they're trying to do is to tackle this aging population issue, front, right, up in front. So that's what education today. A month ago, then video games a couple of weeks ago, and there are other sectors that are important, right, to birth rate, like the housing sector. That's something we should all be looking at and thinking about. Now, the third big challenge facing China today is the environmental or the pollution challenge. Right? China is the largest carbon emitter in the world right now. We account for close to 30% of all carbon emitted. Now, of course, on a per capita basis, it's still much smaller than the U.S. or Europe. Okay, but on if you look at the total quantity, we're about twice as large as the U.S. Okay. So again, there's going to be a lot of policies targeting the environment, right? Trying to solve the pollution issue. Okay, I think it's important, again, just to repeat myself. One is to maintain a balanced sector approach, and number two is to think carefully about where the government may hit next, right? Given their objectives. Yeah.
Yeah. Thank you. The time is running out. Probably it's going to be the last question. And the third question is, there is an opinion that the Chinese government will continue to put the pressure on a few key companies to maintain overall control and regulatory strength. What's your opinion on the policy direction of Chinese government before the launch of the third Xi Jinping government in 2022?
I'll go first. Definitely. I mean, absolutely. I think that with respect to the push and pull of the central government, there's a increasing liberalization of market access and capital markets, but a clear, increasing control of key sectors, and particularly nationally sensitive sectors, whether it's to do with aging population or defense, et cetera. That's a feature of the China market. It doesn't take away from the opportunities. It's just part of the risk profile that you need to be aware of. And again, when I think about China risk, I think about liquidity, right? And so if you've got if you're worried about the geopolitical risk or increasing control by the government, it's about being able to, move quickly in and out of the different sectors or portfolios. That's my opinion. But certainly, it's not, just because there's improving liberalization of the capital markets doesn't necessarily mean there's lessening control.
Yeah, I think I agree with that. I think, again, going back to my earlier point, I think what's, to understand the mentality of the policymakers in China or the regulators in China, we need to understand the sort of the core risks, right, faced by China today. I mean, exerting control is part of the objective, right, of the policymakers. But I think a more important part is we are trying to address those three main concerns, right? The geopolitical contest with the U.S., the demographic shift, and also the environmental challenge. So, we need to kind of look at their objectives and trying to understand, right, what the government or the policymakers are doing, and come up with our own responses to those policies.
Thank you. Good. That's pretty much, I guess. Thank you, Mr. Prescott and Professor Dong. I appreciate your sharing with us your insight and your knowledge with us. Thank you.
Thank you.
And
it's a pleasure. Thank you.
Yeah. What? Go ahead. You want to say last word to the Korean viewers?
I'll just finish by thanking Kofir and everyone again for inviting us and allowing us to present. I hope it was interesting. I hope you saw some information that maybe you hadn't seen before. Feel free to reach out to us or Stephen at any time if you're interested in what we do or you just want to learn more about the China A-share market. And so thank you very much again for having us.
Professor Rowe, last word.
Oh yeah, yeah. Well, Louis summarized it. Yeah, thanks for the opportunity to talk about my own research and the research conducted and Ming-Shi. I hope you find it interesting.
Okay, Stephen.
너무 수고하셨습니다. 감사합니다.
네, 감사합니다. Thank you for joining us.